Is George Gammon wrong about inflation, or is he wrong about being wrong about inflation? He recently did a video on his channel, Rebel Capitalist. He's got 2 channels there. Great video going into some of the details of personal spending power for Americans. And in this video, he's saying, hey, look, the data is showing that we might not actually be in for a quick end to inflation because it looks like the spending power of Americans, given the size of their checking accounts, is far larger than I thought it was. Inflation could persist a lot longer than I thought it could. So I want to take this video and respond to that because there was a key that he was focusing on in terms of the size of these checking accounts for Americans that I think is the reason why this inflation won't be able to last as long as he is saying he might think it lasts now, that the average balance for checking accounts is actually a lot lower than what it looks like. Ready? Let's dive in. First things first, a word from today's sponsor, iTrustCapital. Now, most people today are aware of how well gold has performed relative to pretty much every single asset class out there. We've seen an absolute crash take place in tech stocks, in the broad stock market, in cryptocurrencies. We are seeing blood in the streets everywhere, but gold has been keeping up. Gold has been increasing its purchasing power relative to these other assets, and many people want to buy it, but the problem is most people have most of their wealth tied up in their 401k, in their retirement account, maybe even with their current employer. So the question is, how do we invest in gold with our money if we can't do it where our money's currently at? And that's where iTrustCapital comes in. Because unlike your workplace employer plan, like your 401k, you're not just going to have a selection of a couple dozen mutual funds that are only invested in stocks and bonds. And unlike your IRA with a regular stockbroker, with iTrustCapital, you're not just going to have access to the regular stocks, the ETFs, GLD, SLV, things like that. With iTrustCapital, you can invest in physical gold, physical silver, that's all held underneath the banner of the IRA so that you don't have to worry about any tax consequences. You can do traditional IRAs, you can do Roth IRAs, you can make new contributions, or you can even transfer money from your existing retirement account over to iTrustCapital and use that to invest in physical gold, physical silver. Now, they also have other alternative assets available like Bitcoin and cryptocurrencies. And if you use my link in the description below, you will get $100 worth of Bitcoin as a sign-up bonus just for opening an account. You can use that to keep it in Bitcoin, buy other cryptocurrencies, or sell it and buy physical gold, physical silver again in your IRA. With iTrustCapital, sign up with my link in the description today. All right, so I'll link his video at the end just in case you want to go and watch this, but I want to watch a little clip here from what George Gammon says in this video. During this clip, he's going through the various number of ways over the last couple of years that Americans have increased their spending power. And most people, when they think about this, they're like, oh yeah, the stimulus checks. Okay, so everybody got a couple $1,000s, no big deal. That's been spent many times over since then. So he goes through a number of other ways that many Americans have been able to increase their purchasing power, from delaying those student loan payments and many other programs. The one thing that he doesn't talk about here that made arguably the largest impact was what happened with housing. Housing prices exploded, interest rates went down, and so people's purchasing power for homes went through the roof. And anybody who stayed in their home was able to do 2 things. 1, refinance to get a lower payment, and or 2, cash out refinance. And so immediately from what happened in the housing markets, because of what the Federal Reserve did, people were able to increase their purchasing power from lowering their monthly payment. And many of these people got a massive lump sum of cash that they were able to use for things like buying assets or just relying for a savings account. And this was arguably one of the biggest stimulating factors on the economy, is what happened with housing. And most people don't talk about that. That was overlooked here as well. He then goes and looks at this article from the Wall Street Journal talking about Americans tapping those pandemic savings to cope with inflation. In the article, it shows this personal savings rate chart, which I'm actually going to pull up from the Federal Reserve because I think it shows it a little bit more clearly, the personal savings rate. So you can see when we zoom in here on the personal savings rate, back in 2019, 2020, before everything exploded, personal savings rate was up here right around this 7 to 8 level. And right now it's right around 5. And to put that into into historical perspective, it hasn't been this low since the financial crisis, really, and it's continuing to get lower and lower and lower. And so it is only a matter of time until people run out of cash to spend, right? Well, almost. If we take a look, dive into the data a little bit more, again, this is what George Gammon did in this video here. He pointed out that if you go down and you look at the actual checking account balances, it looks like the checking account balances are doing pretty well still. So it's zeroed out at 2019. And so this data is from Chase, and it shows that after the stimulus checks and everything that has happened over the last couple of years, people's checking account balances are still much higher than they were at during 2019. So we have to look at this from a couple of different angles. Number one, we have to look at this through the lens of the personal savings rate. The personal savings rate is a percentage of disposable income. And so when we look at what real disposable income has done over the last few years, we'll have to zoom in here. Disposable income did peak in March of 2021, and it has been on the decline since then, but we are still at a level higher than where we were in 2019 before everything blew up in 2020. Now, if you look at this trend, the trend has broken. The trend would be putting us, right up here. So that major trend line from before these spikes has broken and it is on the decline, but the real disposable income, and this is real, so this is adjusted for the official inflation numbers, is still above where it was at there in 2020. And so the fact that we have the personal savings rate, which is a calculation based on the disposable income, going down below where it was in 2019, that's a big deal. It has taken into account that increased income. Now, given the fact that we are seeing the personal savings rate plummet below levels where we were at in 2019, levels that we haven't been at since the financial crisis, what in the world is going on with these checking account balances? If we take a look again here, we can see that these checking account balances are much higher than they were at in 2019, and this is divided by income quartiles. So we've got the bottom 25 up through the top 25%, and we can see that the percentage change in their checking account balances is much higher. And so this is where I think George Gammon gets the main thing wrong here, because he's saying, hey, look, we don't know by this what the exact numbers are, but even the top 25%, they've got to have a lot of money in there. So I'll play that clip for you.
I would assume their checking accounts have, I don't know. I don't want to seem too out of touch here, but what, like 50 grand? Something like that?
Okay, so there he's talking specifically just about the top 25%, but he says, okay, checking account balances, 50 grand in 2019. So, let's say we're 25%, 30% higher than that right now. I mean, that's a lot of spending power. And that's where I think he gets this wrong here, because we actually can dive in, not to those most recent data, but if we look at the same Chase report, but this one is from 2021. So this is 6 months old still, but it's still pulling from the same 2019 data from earlier. We can actually see here, this is the similar chart that JP Morgan produced, 6 months ago or whenever this was in 2021. Same thing here. They're showing their quartile income levels, and this is the percentage change. But here they actually publish the actual dollar amounts here. This is where I think George Gammon was way off here, because most people don't have 50 grand, 60, even the top 25% of Americans don't have anywhere near that amount in their checking accounts. In fact, the bottom 3/4 of Americans have less than $3,000 in their checking accounts. Even the top 25% here currently is sitting at around 7,000, and this was in 2021. And so the fact that the chart now looks like it's gotten down a little bit lower from there means that even this top 25% of Americans have a lot less than $7,000 in their checking accounts right now. And it's not just at Chase. If we take a look at this data from 2018 from smartasset.com, we can see that the median checking account balance is $2,900. The mean, the average, is $9,000. And so the reason why there's such a big difference there is median versus mean. If you take 100 people in a room, 99 of them have $1, and that last last one has $1 million, then your mean, your average is going to be $500,000, right? But that's not representative of most people in that group. So you have to take the median, because that just looks at, lines them all up and takes the middle person. That's going to be a lot more representative of what most people in that group have. And so the median checking account balance in 2018 was $2,900. So it's higher than that today probably, but when adjusting for the increase in prices and when looking at the economic hardships that a lot of people are starting to encounter now, that's not that much runway. That's 1 month, 2 months, maybe 3 months of runway, depending on if you have more than one checking account in your household and what your income is compared to your expenses. But when we take a look at this in light of all the other data, such as US household debt, where we can see that over the last years, household debt has been doing nothing but going up, housing and non-housing debt. We can break it down by the non-housing debt and see that it's still going up, along with the personal savings rate, which adjusts for this real disposable income, which is adjusted for inflation. So this real personal savings rate been plummeting. I don't think George Gammon was wrong about inflation. I think he's wrong about being wrong about inflation, that the amount of money that people have is a lot smaller than what it looks like based off of that one chart. Most people's checking account balances do not have anywhere near enough to last them 9 months, a year, especially if their income changes or especially if prices continue to go up. And if that was true, if they did have that much money, they wouldn't be drawing down on their personal savings rate. That number wouldn't be going down across the nation. And also we wouldn't see the debt levels get to where they are. Maybe we would. Okay, I can't say that. We might still see debt levels going up if people had large checking and savings account. But the data is there. The checking account balances are not as high. And so it does look like we are nearing an end to inflation here. We're seeing demand destruction. We're seeing unemployment start to take off. We're seeing layoffs start to get talked about. We're seeing hiring freezes happening all over the nation right now. And so we're seeing some of this demand destruction take place. Maybe not in food, maybe not in energy, maybe not in rent, things that people have to buy no matter what. But pretty much everywhere else, we are seeing people have to lock down. They're starting to save. They're starting to only spend money on what they have to, not spend any money on what they just want to, because people are bracing for hard economic times. And especially with the tightening from the Federal Reserve, rising interest rates, debt service costs going up, money leaving circulation, seems like it's only a matter of time before we start to get this crash set in all across the economy. Let me know your thoughts. I'm going to link that video from George Gammon in the description below. As always, he's got a great channel, so you go check him out if you don't already know him. And thank you so much for watching. Have a great day.